One of the biggest banks on the planet just issued a warning that is sending shockwaves through the crypto market. Standard Chartered, the British banking giant that was one of the most bullish institutional voices on crypto just 6 months ago, has now slashed its price targets for Bitcoin, Ethereum, Solana, BNB, and Avalanche, across the board, hard. And this isn't the first cut, it's the second cut in less than 3 months. Bitcoin, they now say $50,000 before any recovery. Ethereum, $1,400. Solana, down to $135 from $250. AVAX, from $100 all the way to $18. But here's what makes this story genuinely fascinating. Buried inside the same report that contains these devastating short-term targets is a long-term forecast that hasn't moved at all. Bitcoin $500,000 by 2030 remains unchanged. ETH $40,000, SOL $2,000. So Standard Chartered is simultaneously saying this is going to get worse before it gets better. But we still think Bitcoin is a $500,000 asset by 2030. That contradiction is the entire story. And in this video, I'm going to unpack it completely, what the cuts actually mean, whether Standard Chartered even deserves to be trusted after cutting their forecasts twice in 3 months, what the macro triggers are that could send prices lower, and what the recovery path looks like if they're right about both the downside and the eventual rebound. Let's get into it. Let me lay out every single cut Standard Chartered made because the scope of this is important. Analyst Jeffrey Kendrick, the bank's head of digital asset research, released this report on February 12th. Here's what he cut. For Bitcoin, 2026 year-end target slashed from $150,000 to $100,000. Near-term warning that BTC could slide all the way to $50,000 first. For Ethereum, 2026 year-end target cut from $7,500 to $4,000. Near-term downside target of $1,400. That would be a nearly 30% drop from where ETH sits right now. For Solana, cut from $250 to $135. For BNB chain, cut from $1,755 to $1,050. For Avalanche, slashed from $100 all the way down to $18. That's an 82% cut in the price target. And to understand the full scope of the reversal here, you need to know where these targets came from. Just a year ago, Standard Chartered was projecting Bitcoin at $300,000 by end 2025. Then in December 2025, they cut to $200,000. Then to $150,000. Now to $100,000 with a $50,000 near-term warning. That's a 67% reduction in their Bitcoin outlook in under 6 months. Either the world changed dramatically, or they had no idea what they were talking about to begin with. Now, to be fair to Kendrick, let me give you the actual reasoning behind these cuts, because it's not just panic, there's a real macro argument here. The central driver, according to Kendrick himself, is ETF-driven pressure. Bitcoin ETF total assets under management peaked above $165 billion in early October 2025. Since then, they've fallen 41% to $96 billion. Nearly $8 billion has been pulled from US Bitcoin ETFs since the highs. And in the week of the February 5th crash alone, $410 million in single-day outflows hit the market. Kendrick's argument is the average Bitcoin ETF holder is now down approximately 25% on their position, and institutional investors who are down 25% don't buy more. They sell to manage risk. Secondly, the macro backdrop. Markets aren't expecting Fed rate cuts before June at the earliest, and that's only if Kevin Warsh, the incoming Fed chair, signals a dovish pivot at his first FOMC meeting. Until then, risk assets face headwinds. Capital flows toward gold and bonds, not Bitcoin. Third, correlation risk. Bitcoin is now moving in closer lockstep with equity markets. As equity weakness persists, Bitcoin gets dragged down with it, regardless of its own fundamentals. These are legitimate concerns, and Standard Chartered isn't alone in raising them. But here's where this gets complicated, and honestly, it's the most important part of this entire story. Standard Chartered has now cut their Bitcoin forecast 3 times in 6 months. June 2025, Bitcoin to $300,000 by year end. December 2025, cut to $200,000, missed it, revised down. February 2026, cut again to $100,000 with a $50,000 near-term warning. Missed it again, revised down. At what point does repeatedly revising your forecast downward stop being responding to new information and start being, we're just following the price wherever it goes and calling it a prediction? One analyst put it bluntly, if Kendrick cuts his forecast a third time, it proves he's simply bad at his job. Banks are supposed to have sophisticated models, proprietary data, and expertise that retail investors don't have access to. If their targets keep changing every 3 months to match wherever the market already is, what value are they actually providing? There's also a sneaky game being played here. Standard Chartered is simultaneously bearish short-term and massively bullish long-term. They're warning Bitcoin goes to $50,000 while maintaining that it hits $500,000 by 2030. If Bitcoin drops to $50,000 and recovers to $100,000 by year end, they say, see, we called the bottom and the recovery. If Bitcoin drops to $50,000 and stays there, they say, we warned you about near-term capitulation. If Bitcoin never drops to $50,000 and just rallies, they quietly update the forecast and point to the $100,000 year-end target. They can't really lose, because the range they've given themselves is so wide it covers almost every possible outcome. That's not rigorous analysis, that's reputation management. Now, let me separate the noise from the signal, because even if Standard Chartered's forecast methodology is questionable, the data they're pointing to is real. The $8 billion in ETF outflows is real. You can verify that on CoinGlass. The 41% decline in Bitcoin ETF assets under management from $165 billion to $96 billion is real and significant. The macro headwinds from delayed Fed cuts and equity correlation are real. Bitcoin is down 23% year to date. It hit a 16-month low of $60,000 last week. That's real. And Kendrick's two key metrics for assessing drawdown severity both support caution. 1. The pullback relative to all-time high. From the October 2025 peak of $126,080 to the recent low of $60,000 is a 52% drawdown. That's significant, though Kendrick notes it's less extreme than the 80% plus drawdowns of 2018 and 2022. 2. The percentage of BTC currently in profit. As price dropped to $60,000, the number of coins that were purchased below current price shrank dramatically. Holders are losing their cushion. Both metrics point to stress. But importantly, Kendrick says, while these metrics show sharp declines, they are not as extreme as in past cycles. And he credits institutional involvement and ETF infrastructure for cushioning the downside this time. Let's talk about what actually has to happen for Bitcoin to reach $50,000. Because Standard Chartered's bear case isn't the base case, it's the downside scenario. Kendrick outlines the bear case clearly. ETF outflows need to accelerate, not stabilize. If Bitcoin ETF holders continue selling, that systematic pressure keeps pushing price lower. Fed rate cuts need to be pushed further out. Right now, no cuts are expected before June. If economic data deteriorates or inflation stays sticky, cuts get pushed to Q3 or Q4. That keeps risk assets under pressure for months longer. Broad equity weakness needs to persist. If the S&P 500 continues declining and Bitcoin's correlation with equities stays high, Bitcoin gets dragged lower regardless of its own fundamentals. If all three of those conditions align simultaneously, and that's a big if, then $50,000 becomes plausible. That would represent a 63% decline from the all-time high. But here's what Standard Chartered is also saying. If those conditions don't persist, the base case is a recovery toward $100,000 by end of 2026. And the long-term bull case, $500,000 by 2030, remains entirely intact. Let me spend a moment on Ethereum specifically, because the $1,400 target deserves its own analysis. Ethereum is currently trading around $1,160. A drop to $1,400 would be a 29% decline from here, and it would push ETH to its lowest price since early 2023. Why is Standard Chartered so bearish on ETH specifically? The core argument is that Ethereum is facing a structural challenge that Bitcoin isn't. While Bitcoin has benefited enormously from ETF adoption and the institutional digital gold narrative, Ethereum's investment thesis is more complex and harder to explain to institutional allocators. Ethereum ETFs launched in 2025, but never gained the same traction as Bitcoin ETFs. The App Store for DeFi narrative is compelling to crypto natives, but confusing to pension fund managers. On top of that, Ethereum faces genuine competition now from Solana for developer mindshare and user activity. Layer 2 solutions like Base are growing, but some of that growth is cannibalizing Ethereum's own fee revenue. And the macro headwind hits ETH even harder than BTC. When risk-off sentiment dominates, capital consolidates into the most understood, most liquid asset, Bitcoin. ETH, Sol, and the rest get sold harder. The $1,400 target isn't a death sentence for Ethereum, but it would test conviction in a way nothing has since 2022. Now here's why this story isn't just doom and gloom. Because Standard Chartered is also telling you exactly what the recovery looks like and when it could happen. Kendrick's base case for recovery has 3 triggers. First, ETF flows need to stabilize and gradually return. Once selling pressure from ETF holders exhausts itself, the bid comes back, and there's a powerful structural reason for that bid to return. Corporations and sovereign entities are still accumulating. Treasury companies are still buying. The strategic Bitcoin reserve is operational. Second, a clear Fed easing timeline. Standard Chartered explicitly says the macro environment could improve around May 2026, assuming Kevin Warsh takes over at the Federal Reserve and signals a more accommodative stance. If rate cut expectations firm up for June or later, risk assets get a forward-looking bid. Third, the long-term adoption curve continuing. Institutional infrastructure, custody solutions, ETFs, regulatory frameworks, is now more developed than it has ever been. That doesn't evaporate during a drawdown. It accelerates the recovery. All right, let me bring this home with something practical. Standard Chartered just issued a bear warning, but they also handed you a roadmap. Here's how to use it. First, understand what this report actually is. It's a large bank managing risk and managing its own reputation simultaneously. Their forecasts have been wrong repeatedly, but the underlying data they're pointing to, ETF outflows, macro headwinds, equity correlation, is worth taking seriously even if the specific price targets are not gospel. Second, the $50,000 level is now on the table as a realistic possibility, not a certainty, a possibility. If you're a long-term holder, ask yourself honestly, if Bitcoin hits $50,000, would you sell? If the answer is yes, you should probably reduce exposure now and plan to re-enter at lower levels. If the answer is no, the current price is irrelevant to your thesis. Third, the ETH $1,400 scenario is the one that should worry Ethereum holders the most. Not because $1,400 means ETH is dead, it doesn't, but because it would represent a 71% drawdown from its recent highs and would severely test conviction across the board. Fourth, watch for the 3 recovery triggers: ETF flow stabilization, Federal Reserve signals in May-June, and continued corporate Bitcoin accumulation. When those start to confirm, Standard Chartered's recovery roadmap becomes the actionable opportunity. Fifth, and this is the key insight, Standard Chartered still believes Bitcoin hits $500,000 by 2030. They cut the near-term targets 3 times and kept the long-term target intact every single time. That tells you something important about where they think the real value lies. Short-term pain, long-term conviction. The question is whether you can survive the former to capture the latter. Drop a comment below. Do you think Bitcoin hits $50,000 before it hits $100,000? That's the call Standard Chartered is making. Let me know where you stand. Subscribe so you don't miss updates as this macro situation develops.